This weekend I may do multiple video updates. I don't know how much time I'll have to do everything in one update here, and don't want things to get too long, too off the point. But there are some developments here that I think are really important, both on a trading perspective and definitely on an investment perspective too. So I'm going to go over a few things here. This first chart is the SPY ETF, so this is the S&P 500. And a couple things to point out. First is I talk a lot about on this blog about the concept of price logic, meaning which direction is showing the larger and faster and more powerful moves. And you can use that to gauge what direction the trend is and what direction corrections are, and also where patterns end and begin, that type of thing. So if we take the high from April to the low in early June, as of Friday, that same amount of time was equaled coming back up, but price has not got back above the April high. So that indicates that this move down was logically stronger than the move up there. So just on that basis alone, we should give some heed to the idea that this trend still could be down, that this rally up since June may be a corrective rally that we'll see roll over and push to new lows. Now, what I wanted really to note here is of importance that happened this week is really what is happening with the smart money and the big money traders. So there's a report published called the Commitment of Traders Report, which the Commodity Futures Trading Commission publishes every Friday, and they publish data for the prior 5 days up till the current week's Tuesday. So let me say that again and show on the chart. So this bar here was Friday. That was yesterday. Today is Saturday morning here. So yesterday, Friday, they published the data for Tuesday, Monday, Friday, Thursday, and Wednesday. So the prior week's trading up to that Tuesday. And that's published every week, and it shows what all of the different classes of futures traders are doing collectively with their money. And what it showed here is that there was a very heavy increase in selling over this last reporting period. So as far as the smart money was selling. So we had the market that was a very strong up week. So this day, this day, this day, this day. So that was a big upward section in the market, and there was a very large increase in selling by the smart money commercial traders in that. So they are starting to unload long positions and initiate new short positions at these levels here. Now, what our goal is as small traders or retail traders, we don't move the market. We don't know what direction the market is going to go. Really, the goal we have is to identify what the people who are actually driving the market are doing in as close to real time as we can identify that, and then to try to infer as correctly as possible what that means about what they are going to do in the future, because that's what actually matters to us as far as making money and making investment decisions. So what I can tell you with objective certainty is they are selling to a relatively heavy extent and an increasing extent as the market pushes back up towards these old highs. I can tell you very objectively that they sold very heavily here. So let's get a price level here around let's say 133ish on the SPY ETF, so 1330 on the S&P 500. So they sold very heavily here, very heavily here, and very heavily here last year. And now as the market is coming back up, we're slightly above that now, up around 1390. But they sold heavily here this year, and they're selling heavily again here. So this price level, this 1330 to 1400 level, they're every time the market's getting up there, they're selling. So we know that whatever you want to call it, on a fundamental or evaluation level, that the largest traders who really drive and push the market, they are selling the market at these levels. So we can say that with objective certainty. Now, what does that mean about the future? Sometimes that's less clear, but if you look at it historically, what it means is they are initiating new shorts at this level, so they do believe the market is going to go down because they're going to they're actually planning on profiting from downward price movement. Now, what I want to note here is that we had this big up day on Friday, big gap up. There was a payroll report, so unemployment report and jobs report there. So there was a news associated. The finance pages were talking about the good news and how the economy is kind of picking up and there were jobs gained and that type of thing. But here's what we saw: is we saw a big price spike. And let me click over to the New York Stock Exchange because I had the volume under there. But we saw volume drop off relatively significantly compared to the last couple of days. So what does that mean? Here's what I think that means. I think that when we see the next Friday's Commitment of Traders report come out, I think I would be willing to wager that we're going to see that they sold again and actually increase their selling even further during this reporting period, because I think the fact that this volume came in low on a news reported item in a very big price move means if new players, if it was like there was money on the sidelines that was really kind of waiting on that jobs report to see, is it going to be good, is it going to be bad, should we get in the market, is it safe, is it not? That's just not how those big money traders work. They're anticipating that all in advance, and the fact that this volume is low can tell us that there wasn't really new money jumping in here and initiating trades. If anything, the drop-off in volume would say that maybe maybe people who were long at these levels were just kind of selling into the late dumb money who was buying here on this news. So the smart money will tend to buy the rumor. So things look bad down here. There was no good news down here really. But they pushed the market up for a couple months straight, and now the good news is coming out, but they're selling into that, and that's the way they tend to work here. So based on that, I think that next week we're going to see another increase in selling, and if that happens, that could push the selling to a pretty extreme level that may correspond to how heavily these commercial smart traders sold at some of these prior highs. That would be very, very significant if that happens, because as of now, the market is still at a lower high relative to this last time we saw such a signal, like a major sell signal. So it's one thing to see a major sell signal at a higher high. Well, that might mean there's a pullback in the trend, but the trend still continues. But if you see, like we did here last summer, where we saw a major selling level here, and then we saw a major sell level come in here at a lower high, then you saw the chart pattern of a head and shoulders pattern. When that happens at a lower high, that should be a big warning signal that that trend is struggling and likely to give way, and at a minimum go below the low of the pullback off the high. So in this case, we should see the market definitely go below there if we get a major type of sell signal here at a lower high. Now, as far as for those that maybe don't buy that case that the market is weak and you need some proof or some confirmation, the two things I would suggest looking at is waiting for next week's Commitment of Traders report to actually see what the smart money is doing, see if they do increase selling. If they do, and especially if it's big, I would say that's good enough for me. Just get the heck out. And I would include investment positions in that for long term. Get the heck out. As far as a price level specifically, the logic of this pattern off the high did not turn back up until this low here. So this was the first move here that really retraced the prior move in less time than it took to form. So even though the low was in here, this initial move up was a little bit slower than that move down. So this level right in here is the one I think is significant as far as this new pattern starting upward. So if you want to wait and really make the market confirm that this analysis is correct or could be correct, then wait for the market to come back down below this June 28th low, or maybe even break this low and have a close below this little cluster of swing lows here, somewhere around 1300, 1308 before selling out or initiating a short position. But that's what I would suggest looking for if you need some proof about the direction of the market here. I've already covered some things regarding pattern and everything in the last few days. if we look at this as a starting point of the logical confirmation of a new upward trend, this first three moves up here was a pretty clear-cut ideal ABC pattern. I have this labeled as an X and a possible new ABC pattern there. I don't know that the pattern labeling is that important, but if that's correct and everything does fit so far with that, we should be looking at a high sometime next week. And ideally probably in this red box here, and that could be a completed pattern, like a double combination pattern, ABC X ABC, and that could end this move up from June and lead to what on a longer term basis could be an absolutely massive decline in stocks. So on an investment basis, my opinion here is, even as of now, if you're not out of stock investments for the long term, to get out now. I know I've sounded those alarm bells at several times during the past when the market was at 1,000, when the market was at 1120, when the market was in the 1200s, when the market was at 1400. But if you wait until the market proves you're right, you're too late. So you got to act on, look at what the big money and the smart money is doing, look at the patterns and act on that before it happens. And then at some point in time, when the situation is reversed, then you can consider, reinvesting. So that's basically what I wanted to cover with the stock market. I'll try and get some more details on this in an upcoming video here as soon as possible, maybe even this weekend. But the next move down could be very, very large and very fast. If this pattern up since the entire 2009 to 2012 bull market is completing, so if the pattern up from here is ending here, then it looks like we should see a pretty massive move down. And if the pattern up from the October 2011 low is ending here, we should see at a minimum, the logical confirmation of that would be that we see a decline faster and larger than this decline or this decline here. That would indicate that this upward pattern is complete. So that would definitely put us down at these levels here. If the whole pattern off the bull market is complete, then we should see a move larger than any of these corrective declines the whole way up happen off of this high here. So we should see a move larger and faster than we saw in 2011 around the, I guess, debt issue with our government here. So we might see a 3 or 4 week move larger than this July to August move in 2011, which was pretty massive. So if we just say, a move that's bigger and faster than that, that would put us back down pretty close to the October lows within about 3 to 4 weeks once that high is in. So we're getting to the point here where some things could change pretty fast. That's really my analysis on stocks. I know that's maybe a little bit of rambling, not clear, but I think it's very, very important. Those are my recommendations on that. I do want to click over to the bond market here. I don't really trade bonds very much, but as from an investment purpose, this is extremely important. The bond market is at all-time highs. So if we look at, let's look at 30-year bond yields, they're basically at all-time lows here, and they're just coming off of that. As of the last couple weeks, the 30-year bond yields, which is inverse of prices. So bond prices are very high, but the yields are very low, meaning the interest you get off of them are very low. It undercut this 2008 panic low in yields, and then has reversed above it and formed a massive bullish engulfing pattern on the yield chart there. And there's beautiful technical divergence on this. So there's a potential double bottom occurring on the chart here, and there has been a very long downtrend in bonds as well. So this is all the way back in 1980. So we've seen bond yields fall for the last 30-some years. So if we get a double bottom, we could, the standard measuring tool would be to, maybe project yields back up in at a minimum 8% or so. And that would just be the minimum chart projection there. So what I'm saying here to recap is that this is the TLT ETF, so this is long-term bond prices. So if in your retirement accounts, especially if you're closer to retirement or in retirement, you have bonds, they're invested in, they own bonds. So if these bond prices fall, your principal is going to get hammered. And it looks to me like bond prices will easily fall. Let's take this 130 down to 80. So at least a solid 40%, but probably a lot more than that longer term. So if that's where the bulk of your nest egg or retirement funds are, and you're going to take a 40% hit over the next year or 2 years with that, you've got to sell that. You can't sit through that. All the technical analysis and all the sentiment analysis and all the large money commitment or trader analysis basically supports the view that we're probably seeing a high in here. So again, if you have retirement funds and bonds, and I would just across the board say any bonds, just sell out of them. The market is at multi-year highs in bonds. It's at all-time highs. So don't feel bad about selling. You're not taking that money and putting it in some high-risk thing. You just sell and sit on the money that you have. Sit in the cash and wait for a better time to invest that money. If you have that money 2, 3, 4 years down the road, and then you have the opportunity to reinvest that money when some things are actually giving a good investment opportunity, there are going to be probably some tremendous gains to be made. But if you don't act now before the crowd, then these things are going to fall hard and fast, and then you're going to be caught in a conundrum of, I should have done it earlier, well maybe it's close to the bottom, maybe I just hang on, that type of thing right now. So I would say across the board, sell bond funds. If you want to shift money from long-term bonds to the very shortest term bills or notes, like treasury notes, 3 months, 6 months, short-term stuff. Those are about as safe as it gets, but I wouldn't even necessarily suggest messing around with something like that. I would just get into cash money market, something as safe as possible, and just sit and wait for things to pan out. And when you see prices come way, way down, then you consider going back into that. One last final word of note for this video is that if you have an investment advisor or a financial planner that you work with, and you say, hey, I think I should sell my bonds, they're probably either going to laugh at you or say, well, no, bonds are really safe, they're doing really well. I mean, look at the returns they've done over the last 5 years, 10 years, 20 years, 30 years, whatever. And that's what everybody's going to say. The crowd will say, at major turning points, the crowd is always going to say, well, look, it's going to keep going the way it's been going. It's been doing that. It's obvious, So you have to have the strength and the certainty to act against the crowd and against those people that maybe you feel like know more than you about things like that. So that's my take on bonds and stocks. Gold, same deal. If you have any other investment classes, really, you just want to have cash. You want to sell out. You want to have your money that you've earned and you've saved to this point, and just keep it and wait for some things to pan out. If you want to actually try and make a profit on something, what I would suggest is a long U.S. dollar ETF, or possibly some type of short foreign currency ETF. I personally have some money in cash and some money in the EUO ETF, which is an inverse euro ETF. So basically, as our currency rises relative to foreign currencies, that will gain. I actually am planning this coming week on initiating some retirement fund money into an inverse stock ETF as well. I think the pattern is clear enough, and we're going to see some explosive moves that makes sense to do at this point. But the safe thing to do is just get out of investments and into cash. So you keep your money and just wait. And that goes across the board for stocks, for bonds, for currencies, for all of that stuff. So for gold, for commodities as well. So hopefully that's helpful. That's more of an investment focused video here. I will try to post something this weekend on the trading setup, but again, I showed that we should be looking for probably a daily high here some point mid this week. And so for shorter term traders, you could look for that time window to act on any nice signals to short the market or go inverse the market. That's all for this video. Have a great day.